So you won that big project. Congratulations. Now what's next? We want to look at today why payment terms and cash flow matter on that big project. So we're going to walk through 4 scenarios here and highlight some of the risks along the way and what you can do to minimize those risks. So first off, in this case, we have a project of 200,000 with materials of 80,000, leading to gross margin on the project of 120,000 or 60% gross margin percentage. Then we have another 60,000 in labor, leading to 30% contribution margin. These two I'm going to get to in a moment, but let's say you're newer to the projects and you didn't set up any terms. So this entire project is going to be paid in cash. Now down here, we can see that we have a number of different steps that will happen along the way in a project from a cash perspective. So we have the actual signing on that customer for the project. There may be a deposit. We're going to need to order materials. We're going to pay labor, invoice, collect cash, pay materials, and then we have our profit number at the end. That's what would be left in the bank account if this was the only project. And it could go towards paying overheads. So this would not be a net profit, it would be a profit from the project. So in this scenario, we have an all cash project. We don't even have supplier terms set up yet. So you can see they sign on, no deposit is collected. Now we're gonna need to buy the materials. So that's going to cost us a good chunk of money here, bringing us 80,000. Then we're paying for labor, another 60,000. Now the project is finished, we can invoice, and then we collect our cash. We already paid the materials, so the end profit from the project is 60,000. But along the way, we had to go almost $150,000 in debt in order to make this project happen. So you would have had to put out $150,000 in order to get that $60,000 in the bank. And that cash would have had to come from cash reserves somewhere or a line of credit or something along those lines. Now, if you set up your supplier accounts, we can see we're delaying the materials purchase and we're paying materials after we collect the cash. So here, we're gonna order our materials. We don't have to pay for them yet, but we will still have to pay labor. It's very hard to be not paying labor. This is where sometimes using subcontractors can help to delay a project cash flow. But in this case, we're paying labor as employees. We're invoicing, collecting the cash, paying materials. So here, rather than going almost $150,000 in the hole, we're going about $60,000 for that labor. That's still money that has to come from somewhere. Now, let's take into account a scenario where we're going to collect a deposit up front, but again, we still don't have the ability to defer our materials purchase for whatever reason. So here you can see we collected a 25% deposit on the project, so that's 50,000. Then we ordered materials, paid our labor, etc., etc. Here we get to almost 100,000 in the hole. Now, if I increase the deposit to 50%, you can see only $40,000 there. So let's look at the final scenario here. We have deposit and delay materials. So we collect the deposit, order the materials, pay the labor. Once it all goes through, we're really only in a small amount of money out. And so here, there's not that much risk. And then we collect the money, go through. Now, if we collected a 50% deposit on this one, in this 4th scenario, we are never out cash. And this is going to help a company grow because if you don't have to be financing all of your projects and you're instead able to collect the cash either upfront or along the way at intervals that make sense, you're not going to be using cash to grow. However, that's not always going to be possible depending on the project itself and who you're working for, things like that. But as much as possible, shifting that whole cash flow forward, it's going to insulate you from risk and it's going to help you to grow without burning a cash hole. Now, the thing to keep in mind also is that we have assumed that we are actually getting paid in every one of these projects. And it's very frequent, well, not very frequent, but it does happen that a project doesn't end up getting paid out for whatever reason. This is not a completely uncommon scenario. So if we say, okay, the project doesn't get paid out, then in every single scenario here, we do lose money, but you can see the projects that collected the deposit, they lose significantly less. So you're going to lose, in this scenario, basically 100,000 less. So you do want to keep in mind, and that's just from the deposit being collected up front. You have secured some cash, which is going to help you out a lot. So these are some things to keep in mind, especially when thinking through both insulating your business from risk, as well as how much money do you need to mobilize a project, as well as what is going to happen when you grow.